Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. This is our week in review for the week ending July 24th, 2026. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Head of Applied Research and Analytics. This week, geopolitical and trade risks return to the center of market conversation. Escalating conflict between the U.S. and Iran pushed oil prices higher and raised new concerns about inflation, while the administration announced additional tariffs on Canadian goods. Yet stocks continue to rally, led by renewed enthusiasm for AI and semiconductor companies, as corporate earnings offered further evidence of a resilient consumer. Later in today's episode, we'll also break down AMC's earnings and what they tell us about theater credit, look at how companies like Verizon, Pep Boys, and Cracker Barrel are rethinking their real estate strategies. And in a special Digging Through the Data segment, we'll ask a simple question. Are investors actually pricing AI risk into data center CMBS? Or are traditional credit fundamentals still winning the day? So Stephen, with energy prices and tariffs both threatening to add inflationary pressure, but equities still moving higher, how are you interpreting the market's reaction?
Well, it's a striking combination. Brent crude settled above $91 per barrel on Tuesday. On Wednesday, it was pushing 93, 94 as this U.S.-Iran conflict intensified and Houthi threats created another potential disruption to global shipping. So that is beginning to affect the interest rate outlook. The 10-year Treasury yield moved up to roughly 4.64%. And just generally, the yield curve has shifted up. We're not quite at that level of like bearishness pricing in the Social Security 2031 reset that potentially we might be staring down the barrel of come 2028, but this is still not good for interest-sensitive assets. But you have this other side of the coin here. Keep in mind, earnings are up like 28% on the S&P 500. 28%. Now, granted, about 40% of that weight is semiconductors, but you're seeing the broadening out for things like, say, industrials, finance, and the healthcare sector. So generally speaking, earnings are crushing it, right? That's pushing equity valuations higher, but at the same time, the yield curve is pushing higher as well. Now, that trade policy added a second potential inflation channel. The administration announcing another 50% tariffs on nearly $20 billion in Canadian goods. Energy and critical minerals were excluded, and negotiations are continuing, but the measures still create uncertainty for autos and in industries built around integrated North American supply chains. So it's really interesting, Lonnie. We're kind of looking through those risks, but the inflation pressure is once again front and center. Oh, this is like Groundhog Day. It's driving me nuts. You?
Well, I mean, I think we had gone maybe 4 or 5 episodes, maybe even a little longer without having a focus on uncertainty. And so it's made its way back into the conversation here. And, I think last week you did a good job of calling the CPI print and inflationary, kind of reprieve as a head fake. And sure enough, this escalation has happened with the Iran conflict. And so everything that we thought we maybe were past is right back front and center here. And, I know we even joked a little bit about gas prices last week. And, diesel prices are now back to like $4.70 a gallon. Some of that's reactionary and not really based on any reason at this point. Like it's just kind of people preparing for what's coming down the pipeline. But it's there, and it's real for those of us that are consumers. So, look, I think it's just this crazy narrative as you outlined. If you look at the equities, it tells you one thing. If you look at all of this, like, other conflict, geopolitical, inflation, interest rate, 10-year, all this stuff is telling you completely different. And that's kind of where we've been for a very long time. And things keep moving, and I'm certain they will until they just decide not to work anymore. I mean, like I got to imagine the oil's getting a little bit beat up here in this engine, and at some point it's not going to provide the viscosity that it needs to keep things moving.
Ooh, I like the auto reference. I've been watching some like auto episodes recently on trading cars. Long story short, a luxury auto dealer out of Atlanta, Ed Bolin, puts on some like really fun content. VinWiki. And anyway, those metaphors, those analogies have been rolling around in my head. So I like that you're on the same page as me, pulling in an auto reference for this week.
Well,
It's like,
yeah,
if you haven't watched any of his videos, really interesting
yeah.
stuff.
Listen, it's not just auto, Stephen. I mean, it was a play on the oil here, So like we're gonna have some oil issues. I think I heard this week where the strategic reserve in the U.S. is at the lowest level since the 1980s, and when you hear those things, like we're a little bit numb to it at some level because that ebbs and flows, and for political reasons, people have tapped into the petroleum reserve, and they seem to be able to fill it back up, et cetera. But when you start hearing things like it's at the lowest level since the 1980s, it does put a little bit of pause in it, and it makes you wonder, like, does this really mean that we're maybe on the precipice of something considerably more difficult than what we've experienced thus far? I don't think so. I think cooler heads will prevail, or politics will take over, and people will do things that they have to do. But it's definitely a period of uncertainty again, and I'm not a fan of that. I mean, I think I like the fact that we were able to actually start talking about some of the fundamentals and things over the last several weeks, and we're just cast right back into where we've been for probably the last 12 or 18 months.
Yeah, and what's unfortunate here is the shift for some of these disruptions. So this past week, one of the big changes has been kind of the renewal of the Houthi militants threatening to blockade Saudi shipping. So what's happened here is we have disruptions in two critical shipping regions, the Red Sea and the Black Sea. So this past week, two tankers carrying Saudi crude reversed course after Yemen's Houthi militants threatened to blockade Saudi shipping through the Bab al-Mandeb Strait. Other commercial vessels also turned around, but that threat is especially consequential because Iran's restrictions on the Strait of Hormuz have forced Saudi Arabia to redirect much of its oil through the Red Sea. Loadings from one of Saudi Arabia's main ports have increased from roughly 1 million to 4 million barrels per day since the war began. Another 2.5 million barrels per day travel south through Bab al-Mandeb toward Asian customers. So a prolonged disruption of both of these maritime routes really is putting a chokehold on about 1/4 of global oil supplies. Layer on top of that, the really escalated attacks from Ukraine on Russia, and oil and just generally crude is in a really difficult spot right now. So personally, I think it's hard to ever forecast crude prices, but the momentum has been certainly in one direction. And I got to say, just being a pedestrian in that space, right, trying to basically read the tea leaves and say, okay, well, what are oil traders telling me is likely to happen? Are tensions likely to de-escalate, or are we going to continue to see these threats escalate and oil supplies be further disrupted? Well, right now, crude, again, is trending one way, up. So that's telling me oil traders, who generally are the best informed folks in the room, are not expecting a de-escalation anytime soon.
Yeah, it's unfortunate. And it'll have ripple effects. I mean, the tariff stuff doesn't cause me to concern. The oil stuff is definitely concerning, and we've seen the implications. And when we start talking about things, being significant percentages of global supply, that's when it hits the radar is not good. So obviously for our listeners, we'll be keeping you up to date on this as things happen in real time. I know we have a lot of really good, cool CRE stories to get into today, Stephen.
Yeah, I think we should pivot here. We want to talk about earnings season, and one that really caught the market's eye this week was probably one of the biggest earnings stories of the week, and that was AMC reporting an all-time high quarterly revenue of $1.6 billion on Monday. They also surprised the market with a profit. So why don't you guys walk us through what stood out to you about this headline, and then maybe we can get into what this tells us about the theater sector from a commercial real estate perspective.
Well, before I get into AMC earnings, Lonnie, I was just waiting for you to make a joke about our odyssey through the outline today.
Well, you stole my thunder, Stephen, because obviously as we talk about AMC and their great report here, Odyssey and others are driving a lot of that interest back into the theater experience. And so, but well played, sir. Well played.
Matt Damon was in our office a few weeks ago. Not necessarily our office, but in our lobby. So he's doing a lot of press right in New York City for this.
It's a big deal. I mean, he was at the World Cup too. So I think that was a 2-for-1 special. Well, AMC has had a very good week this week. They reported second quarter revenue of $1.6 billion, beating expectations of $1.47 billion, while adjusted earnings came in at 14 cents per share compared with an expected loss of 6 cents per share. The quarter featured 6 separate films that each surpassed 75 million at the domestic box office in their opening weekends, which helped drive traffic. I mean, that is a phenomenal quarter. As a quick little aside here, I have a friend who has done very, very well in I want to say at least half a dozen, maybe a dozen different trading episodes with AMC stock. Said, look, if you look at AMC stock going into some of these major earnings releases, when they have had a string of huge box office hits, the market tends to underestimate the revenue. And this is yet another example of that pattern playing out. U.S. attendance increased 12% year over year, while European attendance rose approximately 18%. Domestic revenue grew 13%, outperforming the broader domestic box office's 10.7% increase. Adjusted EBITDA margin expanded from 13.6 to 20.1%. And first half adjusted EBITDA reached $359.7 million, up from $131.8 million during the same period last year. That is fantastic growth. Importantly, AMC also refinanced $400 million of debt, raised approximately $285 through equity offerings, and eliminated or began eliminating roughly $282 million of debt. The transactions extended maturities and could reduce annual interest expense by approximately $67 million and left AMC with no expected debt maturities until 2029. So a stronger film slate is translating to real operating improvement, while AMC's refinancing and equity raises have bought additional time to repair its heavily leveraged balance sheet. Now, Lonnie, we have some really fun CMBS data here to do a data check as well. AMC has a decent footprint in the CMBS market with a presence in almost 160 properties with a total original balance of approximately $14 billion. Now, that's not the pro rata AMC exposure balance. That's just the total loan balance for any property or loan touching AMC's presence. Now, importantly, the delinquency rate on AMC exposure is very much improved. Currently, it sits at right about 2%, which is down significantly from its COVID era high of over 6% delinquency on all of AMC's properties. While AMC often pays a fixed rent for its lease space, that's not always the case. So we wanted to highlight one of the more interesting AMC leases that showed up in a recent securitization, which was West Roads Mall, which was in a 2026 Wells Fargo securitization. Here, AMC is paying a pure percentage rent equal to 50% of its earnings before interest, taxes, depreciation, amortization, and rent, or EBITDAR. AMC does not have any renewal options at the property. This is an interesting one. They don't have any renewal options. At the same time, they also don't have any termination rights, even if EBITDAR is negative for a full year. So it's a strong lease, and this is an IMAX location as well. So obviously, if AMC likes this property, it's operating well, maybe it's just at the end of 5 years, maybe they contemplate restructuring this lease, or maybe the percentage rents they feel is working really well for this location.
Yeah, it's always interesting when you get into the percentage rent scenarios because 50% of that EBITDAR is a pretty high number, but it does give them some downside protection relative to them not having attendance and their revenues being impacted. Like they get the real benefit of an impaired attendance revenue trailing down to what they actually pay. In markets like this where they're killing it, they're probably paying a lot more than they would if they were in a fixed rate scenario, but that's just the game that they play. It'll be interesting to see how this one plays out. I think the lack of renewal options and lack of termination options makes this one very interesting because both sides will be trying to renegotiate if and when, stating that either this is really negatively impacting them or from the landlord perspective, this is a great setup and they want to keep it in place. This is one of those businesses, Stephen, where the success of their business really is predicated on the strength of the films that come through. And you've seen it doesn't take a whole lot of films. It doesn't take 24. I mean, if you have six films that are producing 75 million plus at the box office, it appears that that's enough to get the attendance at a level that dramatically improves their operations and their revenue. And so I'm excited to see numbers like a 12% increase in attendance year over year in the US, because that attendance usually has trickle down impacts, because most of these centers are going to be located either in a shopping mall or in another retail location where there's, potential for people to go and eat dinner before or after or have drinks or something else. And so you imagine that this, increased activity at the movies themselves leads to some additional trickle down benefits for those other retailers that are either attached or surrounding these locations. So this is a really positive story. I'm excited to have this kind of jump up on the outline this week, because I know during COVID we did a lot of deep dive research on movie theaters and the negative impacts that they were feeling. And these guys don't have small footprints, as you mentioned. I mean, just in the CMBS market, we're tracking 160 properties, 14 billion for AMC specifically. This is it's a pretty big deal.
Yeah, I mean, this is a fun location. It's been in operation since 2008. So AMC has some fantastic historical data, they're going to dig through, and how they decide really what they do at this location and how they structure the rent. And I got to say, I'm interested to see what the third quarter earnings end up looking like, because the Odyssey has been absolutely nuts. I mean, the Rotten Tomato score is off the charts. It was like 95 or 97%, I think. And for this to be the first film shot exclusively in 70 millimeter IMAX film, that's pretty cool. I mean, IMAX only makes, a couple of those cameras a year. And I think Nolan is like basically their biggest customer.
So let's turn here to a few other stories that caught our attention this week. We saw several companies that are making different real estate decisions, but it seems like for similar reasons. Whether that's Verizon, Pep Boys, or Cracker Barrel, they're all trying to optimize their real estate footprint. So let's start with Verizon. We saw a headline in The Real Deal that Verizon is set to sell 274 company-owned retail locations to franchise operators, reducing its direct real estate and operating expenses. So walk us through this story and how this could impact commercial real estate broadly.
Yes, this was a big story. A number of different outlets covered the story, but I got to say, I like The Real Deal's coverage on it. They pulled together a lot of different details here. So the restructuring will eliminate approximately 3,000 jobs, including roughly 500 corporate positions. Verizon expects to retain approximately 1,000 company-owned stores, which management reportedly considers, quote, its minimum retail footprint for the next 3 years. This follows Verizon's divestment of approximately 200 stores last fall and a record workforce reduction of roughly 13,000 employees. The company is simplifying its wireless plans and customer fees as it competes with T-Mobile, AT&T, and potentially a more active Starlink offering. Verizon is continuing to reduce its directly operated retail portfolio, but the stores are being transferred to franchisees rather than necessarily closed. Meanwhile, the company remains willing to commit to strategic office space, including its nearly 200,000 square foot lease at Penn 2 in Manhattan last year. This is interesting because Verizon is facing really stiff competition. I mean, shoot, they took out a lot of ad time on the World Cup these last 2 months, basically. And I mean, shoot, they went deep into the archive for these ads too. I don't know if you saw them, guys, but they had Mike Myers playing Dr. Evil in this ad. I gotta say that gave me a good chuckle.
Yeah, but how does that translate into driving customers? I don't know that there's a direct connection there. This is one to watch. I mean, what I'm wondering here, Stephen, is what is the appeal to be a franchisee owner of these stores when the corporate's effectively saying, like, we've eliminated 3,000 jobs, including 500 corporate positions. And, we're basically saying 1,000 company-owned stores is kind of what we need. This is an interesting dynamic for me. I mean, it's an incredibly competitive marketplace with AT&T, T-Mobile, and some of these others. And if Starlink actually starts hitting critical mass here, I think they're positioned to be a significant competitor. And I would expect to see some consolidation across the industry if Starlink comes online at any real scale. But I don't know. To me, Verizon and these others, their retail outlets are usually inline space and like a strip center. They pay significantly above market rents, and their footprints are just not conducive for like a great customer experience. And in 2026, I mean, I don't know. If I can just go online and order a phone and have it shipped to me next day, I don't know really what the need is. Like you're not even using physical SIM cards in these phones anymore. Everything's digital. Like what is the impetus to even have such a broad footprint? Like I think this is a dying business model.
Yeah, I mean, you're capturing some of the older demographic that just kind of refuses to go the online route. So, I mean, the physical store presence is necessary for probably a quarter to a third of their customer base, and so that's part of the customer retention strategy. But AT&T has gotten really creative. I mean, I got to give them props because they've kind of shaken up the model a little bit. Now, if you sign up for AT&T home internet services, it's not just the person like installing your internet. They actually send out a second rep that's going to try and get you to sign up for their wireless plan. And you basically get a concierge service. They'll take care of your wireless plan and bring you the physical phone, the hardware to your house. That's awesome. I'm not having to go into a store and deal with anybody. So AT&T is really getting creative and tactical in their approach to try and broaden out their customer base.
Yeah, I think that's a much more sustainable model going forward. And I think a lot of these have already transitioned into Best Buy locations or Walmart locations or others where they have sales reps and others that can, provide that kind of real-time service that people want for those demographics you outline, but without the cost of having like your own standalone storefront. And so this to me has vibes kind of like the pharmacies and drugstores where there was a massive expansion and it was necessary and supported, 20 years ago, but the markets have shifted and the dynamics have changed. And I think you'll see them, like in your AT&T example, trying to find some alternative ways to get in front of people without the heavy overhead of property tax, insurance, maintenance, and everything else that comes with the real estate portfolio.
Now, what was interesting here is Verizon wasn't the only corporate real estate news we had out this week. We actually had two other fairly major announcements. Icon Enterprises agreed to sell Pep Boys' operating business to Mavis Tire for approximately $700 million in cash. But interestingly, Icon will retain the company-owned real estate previously separated from the retailer. Mavis will operate nearly 800 Pep Boys locations, presumably creating a landlord-tenant relationship at the retained properties. I like that play. And then in other news, we had Cracker Barrel completed a sale leaseback of 26 company-owned restaurants, generating approximately $77 million of net proceeds that will be used to reduce debt. The company simultaneously sold its Maple Street Biscuit Company business as it refocuses on the core Cracker Barrel brand. I mean, golly, poor Cracker Barrel, man. They have been beaten up with that rebrand and have really had to dig deep into the strategy playbook to try and recapitalize, reposition, and refocus.
Yeah, I mean, this is just a great story of how image and marketing and reputation matter. And when in Cracker Barrel's instance, you screw that up, there are real financial implications for that. And it takes time to come back from it. I mean, people are fickle generally, and I think things revert to the mean at some level eventually on a long enough time horizon. But in that interim period where people, read headlines or don't agree with the strategy, they don't come back immediately, and it puts downward pressure on these firms. And I do think Cracker Barrel made a good pivot when saying like we're going to stick with our core brand and we're going to not go to this kind of new modern frame. But it doesn't mean that everyone's coming back, and we'll see how this plays itself out. I mean, they're so well established. I mean, they're across the U.S. I think, with competent leadership, they can be fine. But you're going to see them having to maybe execute some of these non-traditional types of plays. And the Pep Boys stuff is really interesting too. I mean, Mavis has been on fire. I know here in the Dallas market, they've opened up several new storefronts over the last couple of years to the point where it's noticeable. Just driving down the road, you're like, wow, I've seen 4 or 5 of them. Whereas 10 years ago, I didn't know they were even here. And so this probably helps them accelerate that expansion without having to have all of the hard cost of actually building the locations or buying the real estate. And so we'll see how that plays out as well, because it's an interesting combination with Icon and Mavis partnering up on some of these, potential landlord-tenant type of relationships.
We have a lot of data to dig through today. So let's move on to this segment here. As we all know, and we've been talking about for a year plus, one of the biggest stories in commercial real estate this year has been data centers and AI. But at the same time, as we've been walking through, we're seeing more headlines about community pushback, power constraints, and the cost of all this infrastructure. So we tracked four deals that priced between May 1st and July 1st, which really give investors a chance to compare them side by side. But before we get into the deals themselves, Lonnie and Steven, why don't you walk us through what the big question was that we wanted to answer with this analysis and some of the findings?
Sure. So we had three data center deals brought to market within right about 1 month. I mean, so this was a really heavy wave of issuance. And importantly, what raised eyebrows was this is the first time we've seen some data center deals price wide of their initial price talk. Usually, when an issuer brings a deal to market, they have a fairly good idea of where it will price. And ideally, what the issuer wants is for interest to be so heavy in the deal that they end up being able to tighten the pricing spread, right? That raises the price, that gives them better execution, that creates more profit. But in this case, the opposite happened. So the question is the CMBS market getting spooked by the backlash against AI infrastructure, or is old-fashioned credit underwriting still driving the pricing hierarchy? Or we could really throw in a third, or is this just simply we had a wave of issuance and this is the natural result of, well, investors only have so much capital that they can spread around. And so we were just bumping up against the wall of supply-demand constraints. So between June 9th and July 1st, three data center SASB deals brought roughly $3.1 billion of mortgage debt to the market in 22 days. Two of these widened from initial pricing talk, one held, and that divergence is the story. So the four deals that we had price, and I'm going to list these in order from the tightest pricing to the widest, not chronological order. This is in order from their pricing execution. So the first was the Blue Owl deal, BODI or BODI 2026 DC1. Next, we have the Blackstone 2026 Volt 10 deal. And then we had Cone 2026 ACD6. Now, I skipped one here. I also included one other deal in this analysis that priced back on May 1st. That was our last data center deal we had before this pricing wave. And that was Cone 2026 DFW 3. So that one actually priced, that DFW 3 deal ended up pricing 10 basis points tighter than the one that priced in July, the ACD6 deal. So the Blue Owl deal priced at 120 over treasuries. Blackstone priced at 140. The DFW 3 deal back in May priced at 165. And the Cone ACD6 deal that priced July 1st priced at 175. So the Blue Owl deal priced at the initial price talk at 120. The Blackstone deal priced 10 wider than its initial price talk at 140. And the Cone ACD6 deal priced 10 wider at 175. So what was driving that pricing delta between the tightest and the widest? It's a 55 basis point spread between the Blue Owl and the Cone ACD6 deal. Well, a big part of this ultimately had to do with the leasing structure. The LTV or leverage was part of the story as well, but honestly, the lease term and the IG credit drove the majority of this. So the Blue Owl deal had a weighted average remaining lease term of 13.8 years, was 100% IG rent to a AA tenant. The Blackstone deal had 19 and a half years, again, 100% IG rent, and that was a AA minus tenant. And then the Cone ACD6 deal only had 4.7 years of lease term and was only 48.7% IG rent. So, I mean, that to me explains a majority of this pricing spread. The LTV is the other part. The Blue Owl deal had the lowest leverage of any of them, 58.3% LTV, Blackstone, 74.9%, and the Cone ACD6 deal was 58.6%. So yeah, the Cone deal had low leverage, but that lease term and the IG credit was really a big risk that bond investors demanded extra compensation to hold.
Yeah, if you look at the Blackstone deal, Stephen, in particular, 75% effectively on the LTV. Debt yield was 8.7, so considerably less than everything else. But that 19 and a half years and 100% investment grade tenant really moved the needle for them. Whereas if you contrast that with the Cone deal, as you mentioned, the lease term, I think, is really, and the tenant, tenancy is driving this one because the leverage is solid and the debt yield is at 10.5. So, from what we see traditionally, that would be a very solid deal. But when you only have 4.7 years left on the vault and, investment grade tenants make up 48% instead of 100 on these other deals. That adds some significant risk premium that has to be accounted for. So these are interesting. And we've talked a lot about, where these sit in the system, if they're real estate, if they're not, who knows what, how do you talk about them price per foot? If you talk about them, from an energy perspective, et cetera, et cetera. But this is a very simple kind of just like broad perspective of how the market views these things. And I think the WALT and the tenant composition is probably the two at this point, at least from this small sample, the dominating forces driving how the markets interacted or interpreted the risk here.
Now, at the same time, though, it's kind of hard not to wonder if there was a little bit of a sentiment premium that was getting priced into these deals because of just the overwhelming number of headlines we've seen of, data center moratoriums, pushback on energy pricing, water consumption. I mean, there's a lot of community pushback on these data centers. So for me, I do question if there's a little bit of a sentiment premium that's getting built into these as well. Now, we have a very funny tongue-in-cheek term for this sentiment premium. We're dubbing it the AI Luddite premium. So if you remember back from your, high school history days, this is like ancient history for most of us. The Luddites were the 19th century English textile workers who destroyed automated looms to protest job losses. So we're just reusing that Luddite term, and the AI Luddite has come to describe the broader opposition to the AI infrastructure build-out, including the community groups pushing back on power consumption, water use, and tax breaks for hyperscalers, and that whole ecosystem of concern. So I suspect that maybe at some level, a little bit of this premium may be related to that. But the flip side is the pushback on development is creating supply constraint. So as we've mentioned before on the podcast, that could end up being a benefit to some of these centers because we have yet to see a full business cycle, a full lease cycle play out and see, how many of these centers are able to release? How difficult are they? How future-proof are they? Because that is a huge question that remains. And what makes me love the Blue Owl and the Blackstone deals, right? It's not just their long weighted average remaining lease term and the high grade credit. These are 10-year deals that have a 20-year ARD. Well, at least the Blackstone has a 20-year ARD structure. And so what happens is if the borrower does not pay off the debt at that 10-year maturity, hyper amortization kicks in and you sweep excess cash flow and rapidly pay down the debt. And so the Blue Owl deal would actually deleverage the most, but the Blackstone deal has pretty significant deleveraging built into it. So when I look at these, the Blackstone deal to me, like if I was investing money as a bond investor, personally, this is just my personal preference, so feel free to disagree, but to me, the Blackstone deal is my favorite, right? It priced wide of the Blue Owl at 140, and it's a 20-year lease. It's bulletproof. There's no termination rights. If you read the footnotes for the Blue Owl deal, that one has some hair on it in the lease structure. You do have the ability to terminate. You also, importantly, have the ability to assign without approval, right? So I could get a lower grade tenant without having to approve it. I mean, that kind of risk built in at a 120 spread, to me, just isn't as attractive as the Blackstone, even though it's higher leverage, because you get hyper-am deleveraging in the back end if it doesn't pay off.
Yeah, I'm with you, Stephen. I think the Blackstone deal would be the preference for the reasons you mentioned. And for those listening, I know we've kind of gone through fairly extensive amount of data here in our audio version podcast. We do have some tables of some of this data that we could share with you if you're interested. I think Stephen might be working on putting this into a more formal, blog post or something else. So keep an eye out for that as we continue to see these things evolve real time. And, it's interesting as you talk about the sentiment preference, Stephen, because that's not just for data centers. Obviously, data centers have taken the headlines here, but you could make the case for office and other property sectors that have been, impacted, even with some of the rent-controlled multifamily, that there's definitely that component that's being factored into how the broader marketplace is interacting with these particular property types. And so more to come on that too. I think there's some opportunity. And if you're interested in this data center data, all of the lease term info that Stephen is referencing, all of the covenants and all of the parameters around assignment or any of the other components that we talked about here, like all that's in our deal documentation, all that's in the information that we have in the data set. So, if you want to see a super granular picture of what's taking place, we certainly have the underlying information that we can get in your hands if you're a client of Trepp's.
Okay, so let's pivot here from new issuance and deals to what's happening across existing CMBS loans. We'll turn to our deals and data segment. And what we did here is we rounded up some of our recent special servicing transfers we've seen, appraisal reductions, and loss resolutions to really give our listeners a sense of just how many loans we're tracking that are taking these actions. So let's start with special servicing transfers. I think we've seen about 5 loans, and the value is about $696 million that have transferred in the last week.
Yes. Our two main ones were a $280 million hotel, Santa Monica portfolio, and a $415.6 million set of retail properties across Manhattan, Chicago, Augusta down in Georgia, and a Las Vegas mall. And the primary trigger for these special servicing transfers was, probably no shocker here, a maturity default / imminent default. For appraisal reductions, we had 8 loans totaling $611 million. That breaks down to 5 office loans at $548 million, 1 hotel loan at $26 million, and 2 retail loans at $37 million. And nearly all of those reappraised values now sit below the loan balance, with appraisal declines ranging from 16% on the most benign end of the range to 75% reduction, with the largest concentrated in office. And then finally, we had 1 loan with a loss resolution. That's the $400 million Bank of America Plaza loan in Los Angeles that ended up working out to right about a 44% loss severity, or almost $186 million realized loss. So since office has been really the most dramatic, I would say, credit sector for us across story types, we have 2 trading alerts to walk through this week. The first one is a Philadelphia office value cut that put the value below the loan balance. And that is the $188 million 1700 Market Street loan that was reappraised at a 16% reduction relative to the prior value. And that puts the value now below the outstanding loan balance. The asset was appraised at $273.2 million at securitization, which was subsequently reduced to $199 million in 2024. And this most recent value cut brought the value down to $168 million. We last mentioned this property in a January 26 edition of TreppWire when the property was placed on the sales block by its receiver. Previously, in October 25, we reported that the CMBS trust had undertaken foreclosure efforts, and the loan has been with the special servicer since August of 23. It matured in February 24 without resolution, and a receiver was appointed in September of 24. And the most recent special servicer commentary reports that a sale of the property is anticipated by year-end 2026. The collateral is an 850,000 square foot office in downtown or Center City, Philadelphia. The building includes a parking garage with 675 spaces, as well as a fitness center. It was built in 1968, renovated in 2019, and the top tenants include Reliance Standard Life Insurance Company, Deloitte, and OCSoft, whose leases account for 18, 11, and 7% of rentable area and run through year-end 2031, June 2031, and March 2030, respectively. The other trading alert we had this week was for a New York office that had its value cut below the loan balance amid a workout. This is the $155 million Club Row building, who recently had its value cut by 67%. The asset was appraised at $250 million at securitization in 2014, and this most recent appraisal put the value of the property at only $82.6 million. We mentioned this loan in our May 26 CMBS upcoming hard maturities report, in which we noted that resolution will likely come via a court-driven enforcement or negotiated settlement within the ongoing foreclosure framework, which had been originally set to close in June of 26. The loan transferred to special servicing in January 25 after the borrower failed to repay at maturity. A notice of default was issued shortly thereafter, and foreclosure was filed in July of 25. The borrower responded to the foreclosure complaint in September of 25 with an initial modification, which was conditionally approved but not completed under the original terms. The lender later filed an unopposed motion for summary judgment in February of 26. Following further negotiations, the lender conditionally approved a revised workout, which is actively working toward closing while foreclosure continues to be dual-tracked. The loan collateral is a 369,000 square foot office in Midtown Manhattan, built in 1920 and renovated in 2014. The top tenants include City University of New York, the Breast Cancer Research Foundation, and the Board of Regents of the University of Texas Systems, whose leases account for 21%, 6%, and 4% of rentable area respectively, and run through September 2031, June 2028, and January 27, respectively. During the full year 25, the loan posted a DSCR based on net cash flow of 0.61 times with occupancy of 66%.
This is one of those stories, Stephen, that we used to talk about 5 or 6 of these every week. And, I know we've had a lot of macro and we've not really done as much of the trading alert type of segments on the show. But for those listening out there, these offices that are, getting written down from an appraisal value perspective, I mean, they're still happening at scale. This is not something that we're past in the market cycle. I mean, I know we've been very optimistic and we've had several guests on that talked about the resurgence of office in certain markets. And us personally, both saying, we think that the office market generally has bottomed out. But this distress that's, working its way through the system, we've joked that the headlines move a lot faster than the actual distress. These are indicative of some of the deals that we're still seeing come through month over month where, occupancy is not great, but it's not zero. Debt service coverage is nowhere near 1 times X, and appraised values are just continuing to get slashed. And then to the point that, you're seeing 50, 60, 70% below what you saw at securitization. And so for those looking for distressed buying opportunities, for those looking for dislocation in the market, in the office sector, even in large markets like New York and Philadelphia, there's still ample opportunity. They're just with buildings that probably need a lot of CapEx and need some things to turn them around, notwithstanding just a reset in the basis. So, hopefully people understand we're excited that the market has turned generally, but there's still, a multitude of examples where these maturity defaults are very real, occupancy hasn't fully rebounded, and the buildings need a little bit of TLC to reach their former glory.
So let's turn to multifamily. We wanted to talk about an apartment complex that we've been following for a long time now, and that is the Parkmerced apartment complex in San Francisco. We've talked about this extensively, but this week there was news that Yellowstone has taken over the redevelopment portion of the mega complex. So walk us through some details about this property and then who Yellowstone is. And then maybe, Lonnie, you could share some of your take on San Francisco because we did just release a paper on the narratives there.
Yes, this is a huge development, I think. Because, well, first off, Parkmerced is a massive loan. It's a massive property, and it accounts for a massive portion of multifamily distress in the CMBS multifamily headline delinquency rate. And importantly, there's a lot of future development rights embedded in this deal that have never gotten off the ground. So this is, to me, this is an exciting development to maybe finally move the needle. Parkmerced is a 3,221 unit apartment complex spread across 152 acres in San Francisco near San Francisco State University, a mix of townhomes and high-rise apartment towers. The property was built in 1944, renovated in 2009. At securitization in 2019, it was appraised at $2.11 billion, a figure that had fallen to $1.39 billion by July of 2024. A city-approved redevelopment plan entitled more than a decade ago would add a total of just over 5,600 units, a mix of rentals and condos, plus about 310,000 square feet of commercial space and 27 acres of public open space. 14 years in, not a shovel has hit the ground. So let's walk through the loan and distress timeline. The property's debt stack includes $1.5 billion of securitized debt and $275 million of mezzanine debt. Maximus Real Estate Partners, the San Francisco-based borrower, originally requested to transfer into special servicing in 2024, citing high vacancy and a looming loan maturity. In September 23, Parkmerced's occupancy was 83%, and its debt service coverage ratio was below break-even at 0.47 times. Trepp flagged it as multifamily's biggest delinquent loan when it went delinquent in early 2024. Maximus failed to repay the CMBS loan that came due in December of 24, and lenders Barclays and Citigroup filed suit to appoint a receiver after a long-delayed loan restructuring agreement collapsed late last year. A court-appointed San Diego-based Douglas Wilson Companies moved in as receiver for the complex in March of 25. The receiver described the property as dealing with, quote, severe deferred maintenance, including mold, dry rot, water intrusion, and inoperable elevators, and committed more than $70 million in lender funds toward capital improvements. So Yellowstone Real Estate Investments is a Manhattan-based private equity firm who has come in to basically take over the redevelopment here. They are focused on opportunistic and value-add transactions across the U.S. and investing across the capital structure. The firm is backed by Yakir Gabe, a Cypriot Israeli billionaire, and managed by Isaac Hira, referenced in the tweet we saw as, quote, Hira family. Gabe ranks on the Forbes 2026 billionaires list with an estimated net worth of $4.1 billion. Yellowstone's track record is built on distressed debt and note acquisitions. They've made their name buying defaulted loans on troubled New York City properties, including hotels and office to residential conversions. As recently as March 26, they secured $203 million in financing for an office to residential conversion at 220 West 42nd Street in Times Square. So let's walk through what we know from this announcement and what we still don't know. Per the tweet from an industry journalist, Yellowstone has taken over the redevelopment portion of Parkmerced, specifically, not necessarily the whole debt stack or the existing operating complex. This is very fresh news, and details on the deal structure, price, and the relationship to the senior CMBS lenders, Barclays and Citi, and the receivership are not yet public. So what we're going to watch for is whether they bought into the debt or negotiated a direct assignment of development rights. The key question for any new player is whether to pursue the long-approved redevelopment entitlements. The receiver noted those entitlements are being preserved for, quote, future developers. So the big picture, the forward look, Parkmerced is arguably the most complex single asset distress story in CMBS multifamily, with that $1.8 billion debt stack, 20 years of failed redevelopment, a receivership, deferred maintenance, and now a new opportunistic buyer entering the picture. If Yellowstone follows their New York City playbook of buying distressed notes and executing conversions or redevelopment, this could finally be the catalyst that unlocks 5,600 new units that have been in entitlement for 14 years. I mean, this is crazy. So we'll be watching this process closely as this loan sits squarely in the multifamily distress bucket we've been tracking, with a city that led the nation in outstanding apartment distress in late 23.
I mean, some of these numbers here, Stephen, they just jump off the page. I mean, you have things in entitlements for 14 years, 20 years of a failed redevelopment. I mean, almost $2 billion in debt. I mean, just crazy. I don't know if you've seen the short videos recently of, the Netflix documentary and people making fun of it. But I think you're setting yourself up here with that story of this could be an entire year's worth of real estate education. They could document this, and you could make a documentary of what not to do here. I mean, this is one of those things where I think in practice, you look at all of the prospects here, and it's intriguing and it's exciting, and the redevelopment potential is there. And the deal maker in you wants to say, I can fix it and I can do this and we can execute. But then history has just shown that it just doesn't matter how well capitalized you are or how well positioned you are. It just doesn't materialize. And so this will be one where I think, look, if they can come in and they can take control and they can actually redevelop this, huge upside, huge potential, but history is not on their side here. This is a property that has been, mired in distress for a very long time. And I would probably take the under on this one in terms of them actually realizing the upside, just because it's too difficult to turn something like this around with all of the regulatory and all of the challenges that you get in a San Francisco, ecosystem.
Yeah, this is one of the most difficult MSAs to execute in for a variety of reasons. So, I mean, maybe the road to housing bill and the changing political environment in San Francisco grease the wheels a little bit more than I anticipate, but we'll just have to continue tracking it and find out.
So as mentioned, I know we summarized a lot of the credit stories and trading alerts that we had this week, but we always have more. If you're not signed up for our TreppWire daily email, that means you're not a Trepp client. So reach out to us if you want to learn more about how to get access to our daily insights. And then we do have a lease and transaction newsletter called The Rundown, the CRE Rundown. If you'd like access to that as well, please send us a note. A few other programming notes on our end. We've been talking about our monthly webinars, but it's almost time. On Tuesday, July 28th at 2 p.m. Eastern, we will have our next client-only Trepp CRE webinar. Our team is really excited to share details into our platform's expanded alerts functionality. So this really allows our clients to configure notifications based on the data that they're looking for the market or the property type that they're interested in. So if you're a client and you want to see the latest and greatest from our team, reach out to us at podcast@trepp.com. And if you're not a client and maybe you've seen the platform years or months ago, we are constantly enhancing and adding new data, new tools, new features. So we'd love to get back on the phone with you and walk you through what's new. Reach out to us, podcast@trepp.com, and we will get you on a call with our teams. Also that week on Thursday, July 30th at 2 p.m. Eastern, we will have our monthly Market Pulse webinar that is open to anyone in the industry. We'll really be digging into the CMBS loan life cycle from origination and underwriting through operating performance and today's refinancing environment. You'll get a lot of details about how the 2021 and 2022 CMBS vintages have performed and really what we're tracking now as upcoming maturities are looming. So reach out to us. You still have time to register for the Market Pulse webinar, and we'd love to have you there. Turning to shout outs. Our good friend and client Shlomo C shared some great feedback and posts across X and LinkedIn this week. He posted that the Trepp MCP server is a game changer. And then he gave some examples. I'll read that here so our listeners can understand. He said, think of it this way. If you wanted to acquire a property from a subpar operator, you would search using AI for all properties that are underperforming, but also have repetitive flags for loan document violations over the course of the loan. And AI would search the financials and the servicer commentary history. You're not restricted to a specific query structure. You can teach AI how to navigate the data to pull out what you need. You then would want the AI to run a background check on the owner property and market and spit out a comprehensive report on what's going on within the market in the owner's portfolio, including but not limited to news and other public sources. You can also use data from other proprietary data sources. You'll then essentially walk into a meeting next level prepared. So this is a very specific example that he shared, but it just is one use case of how our MCP server really allows your personal AI agents and AI tools to adjust and build based on the data that Trepp has and based on any other data sources that you're using. So thank you, Shlomo, for sharing that. We always love hearing from you and getting your feedback on our tools and systems, and we hope others will reach out to us if you're interested in learning more or seeing how the MCP server can be used for your work or your workflow. We also heard from Franz B., who was really interested in signing up for the 2 webinars I just mentioned. He is one of our future CRE leaders, so we love to see you continuing to stay involved and learning and growing within the industry. So thanks for reaching out. And he always thanks us for the great podcast that we put on, and we really appreciate the support. Arthur W. was interested in the CRE Rundown newsletter. He said his team has found the insights extremely valuable to our credit risk review work, and they're looking to get access for the whole team. Owen R. heard some of our latest theses that we talked about on the podcast and was interested in our white paper. So if you hear us walk through a digging through the data segment, a 101 segment, and you're looking for more, reach out to us. We probably have a version in written form that we'd love to share with you. David was also interested in our 101 segment we shared last week on back leverage or note-on-note financing. Our colleague Sean M. told us that he met a woman, Stuart B., who speaks very highly of our podcast and is a weekly listener, and she pushes her team to listen to it, and she's been listening since the COVID era. So thank you, Stuart, for continuing to support the show and getting your team listening, and we'd love to hear any feedback or thoughts that you have. Ryan S. was interested in any of our Trepp AI solutions. He's looking to search loan and property details, so Ryan, we will set you up with a member of our team to learn more. Thomas K. was also interested in the back leverage loan-on-loan financing segment. Ricky Y. wanted access to our upcoming CMBS webinar. And Jack R. thanked us for the weekly show and was interested in some of our tech offerings. So thank you, as always, to everyone for listening and reaching out. I'll give another plug. Rate us on Spotify, leave a review on Apple Podcasts, share this show with a friend. We have a lot of good stuff coming. We have more guests than we can even fit onto the calendar right now, but we can't wait to bring you even more insights every week and share with you some of the expertise of our guests from across the industry. So with that, we'll close. Thanks to our producer, Mariana Sabrana. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well. All right.